What's going on, guys? Hope you guys are doing well. Today, we're taking a look at a REIT, or a real estate investment trust. For those of you who don't know what a REIT is, it trades similar to a stock, but the underlying company is given certain tax advantages, and as a result, they have to pass on at least 90% of their earnings onto shareholders through the form of dividends or distributions. So, one caveat to this is because they have these special tax privileges and don't pay any actual tax on the front end, when you get these distributions, most of the time they will not be qualified dividends like you would get from a normal company like Pfizer or Verizon or AT&T. Those are qualified dividends, and those are given preferential tax treatment. So you'll usually pay a pretty low rate on qualified dividends. However, REITs pay out dividends through a number of different ways. They can pay out qualified dividends, although often the dividends do not qualify or fall into the category of that most tax advantaged form. And sometimes they even pay out capital gains. So you do in fact have to pay higher taxes on these dividends if you hold them in a taxable account. So for this reason, I only hold REITs in my Roth IRA, which is a tax-deferred account, all tax-free account, I guess. You put money in there post-income tax, and then once you reach the required age and you start taking distributions, all earnings are tax-free. Similar to the traditional IRA, it's just kind of flipped. On a traditional IRA, you put the money in pre-tax, but then when you withdraw it in retirement, you get taxed. But Roth is kind of the opposite. So by holding one of these inside the Roth, you technically never have to pay any tax on the REIT earnings. Enough of that. So today we're looking at Prologis. So Prologis is it's essentially a real estate business, but what they own is high-tech warehouses. They own a lot of them. They're considered one of the top logistical distribution, I don't know the word for it. They handle the intermediate steps between when say an Amazon item gets sent from one of their warehouses to your front door. So you submit the order. Either the products are already in a Prologis warehouse because they do have Amazon as one of their tenants, or maybe this is an intermediate shipping station on its way to you. If it's not using UPS or FedEx or USPS and it's going through Amazon's own fulfillment services, it's likely passed through one of these facilities. The reason that they are so prestigious is because they make a habit of retrofitting their warehouses to be custom made for customers, to be able to offer specialization that increases efficiency and increases productivity. This is usually along with a long-term lease agreement. So, they're not going to agree to renovate the entire warehouse and put in all these special areas and doors and runways if the company won't commit to a long-term lease. So, for that reason, most of their leases are rather long-term. So, they are navigating this whole crisis decently well, especially with the increase in online shopping. There's a couple sides to this. On the pro side, they are a very resilient business model, and as companies go bankrupt, as we're seeing right now, they have the opportunity to purchase a lot of real estate at very cheap prices, because at their core, they are essentially a real estate business. They just utilize that real estate to produce more income by subletting it out in a manner. So, on the plus side, they have a resilient business model, and they have some pretty high-end clients. Their business is also centered around these long-term leases. So, any drop-offs of customers, you see that coming if they decide they don't want to renew their leases. And you know, every time you sign someone, they're going to be around for a while. So, not a huge issue of being blindsided. Obviously, those leases could be subject to termination if the companies that are leasing them go bankrupt. Most of the positions or facilities that Prologis rents out, they make up less than 1% of their portfolio. So even if there's a couple small businesses, small, I mean relatively, there's still multi-million-dollar businesses, but small relative to like Amazon, they won't really have an impact on Prologis' business model as a whole. So, on the negative side, because of all this, these benefits around their business model, their price has been driven up, and they trade a little higher than most REITs usually do. So, even though they're a REIT, they're only paying about a 2.5% dividend, I believe, which is a little lower traditionally than REITs. Usually REITs pay, a solid REIT will pay anywhere from between like 4 and 8% dividend. So it's a little on the lower side because the price has been driven up because of all this growth potential. They have high value and high stability customers, and they're rather resilient in the time we're in now. So let's just take a look through the site. I'll point out some noticeable things. The one thing I like to look at whenever I go to a website is to look at their investor relations page. I also usually sign up for their email alerts. So anytime anything noteworthy happens, they'll send an email out about the press release they made. You don't have to wait and see it in the news. So, you can see they have $125 billion of assets under management. That is primarily in the form of land and facilities, so real estate. They bring in about $2.9 billion in net operating income. I don't even want to know how much they bring in revenue. They own 965 million square feet of warehouse real estate. They own 4,660 buildings. They have 5,500 customers. Their equity is over 94%, and they have an A- credit rating, which means they are a fairly solid and respectable company. And they're pretty financially stable. Their balance sheet is pretty solid. And as we scroll down here, all these releases, you can sign up to get email notifications about, so you don't have to follow this. I'm sure the prompt's somewhere here down the page to sign up. Right here, investor email alerts. Oh, this is probably a good time to say I'm not a financial advisor. I'm not telling you to buy this stock. There's pros and cons with everything. Do your own research. Consult a financial advisor before you invest. So, if we take a look at their this is a supplemental financial document. It was linked on that last page. Usually these type of investor presentations give you a more easily digestible way of understanding their business model and their clients. So, $2.1 trillion worth of economic value of goods flows through their distribution centers each year. That's about 3.5% of GDP for the 19 countries that they do business in, and 2.5% of the entire world's GDP. That is insane. There are 857,000 employees that work for them. You can see their largest two sectors are consumer goods and food, closely followed by transportation, appliances, and retail. I don't know why clothing and retail aren't combined. Maybe retailers like a Walmart, Target, whereas clothing's like specialized clothing companies. But you can see they're in almost every sector here. Their top 10 customers include Amazon, DHL, which is a shipping company, XPO Logistics, which is a end-to-consumer shipping company, typically for larger items. Geodis, I'm not familiar with them. Home Depot, everyone knows. FedEx, everyone knows. DSV and Kuhn Nagel, I'm not familiar with. Those are probably foreign brands. And then UPS and Walmart, everyone is familiar with. And you can see, if you look at their FFO, which is the funds from operation, that's usually the best way to measure a REIT's progress. It's really not a good measure to use EPS when measuring a REIT, because a lot of the gains and expenditures that are factored in to FFO will actually make it higher than the EPS. So if you were to just look at the EPS, most REITs look like they're never able to afford their dividend. But in actuality, if you look at the FFO, they're almost always covered. And if you look here, they're outlining the performance of Prologis' stock, which trades under the ticker PLD, against a couple key categories here. So against other logistical REITs, they've almost doubled in every category. Against blue chip stocks, they've done even better compared to the average REIT returns. Very similar to the logistic rates here, almost a little over double. And then the S&P here, decently close. Not as far of a discrepancy as these categories, but still pretty close. And then if you look at the dividend growth here, you'll see it looks rather comparative, actually. Not sure why they really chose to include that metric, because the S&P is almost identical. I guess they're just comparing to the blue chip and REIT average. And if we look at their other supplemental document here, this one includes all their balance sheet information. You can see there's a lot of information to take into account here. Most of the time when you are on your broker, especially if you're just looking at something basic like the Apple Stocks app or something, you will never see FFO. So most of the time you either need to go to the company's 10K or 10Q filings directly in the SEC EDGAR database, or you need to go to their investor presentation deck, or sometimes if you Google it, it'll come up, but you gotta make sure you check your sources and the timestamp on it. But that's what you want to use as a measure of the coverage of their dividend and their increased profitability over the years. And these are in thousands, so that's 48 million. And then it needs to be divided by the shares outstanding to give you the FFO per share, which I'm sure they calculate somewhere in here. You can see their occupancy has decreased only slightly coming into 2020. I mean, as to be expected. it's going to decrease a little bit because some of the smaller businesses are going to go under just as a result of the situation we're in now. You can see they have rather high retention rates for customers. You may think it's low, but this is actually pretty common in the industry and commercial space. And actually, because the lease terms are so long, these actually don't come around as often as you believe. Then there's the same store change. This just means like same location, and rent change, so increase in rent. Not as important to me because they handle that all themselves. Here they break down the different countries, so their biggest three: Europe, Asia, and the US, and then the other Americas. That's where the majority of their properties are. You can see that they have 6,477 more square feet, and that's in thousands. So really it's like 6.477 million square feet under development right now. That's not even out yet. And you can see that their total operating portfolio has been somewhat flat, although it's increased. I'm reading this backwards. It's been mostly flat. It looks like they had a spike in Q1 of 2019, and then ever since then it's been rather flat. Probably related to this whole crisis that we're in now, because starting here, because they have so much foreign exposure. As soon as Q4 2019 hit and things started stirring up overseas, they probably saw a decrease in the amount of renters and tenants that they were getting, and they must have downsized their portfolio in some of their riskier areas, since the total operating portfolio and the properties under development dropped decently as a whole for the year. Their capital expenditures, the diversity of their portfolio by unit size. This breaks down the locations of their facilities within specific countries or states, depending on what you're looking at. So you can see that their highest number of buildings owned is actually in SoCal. Not a huge surprise. And then the next biggest, aside from the remaining U.S. markets, which is just like a bundle of the U.S. states they didn't mention here, or areas they didn't mention here, is the Chicago area. Pretty interesting. You can see other places they do business, so Mexico, Canada, Brazil, UK, France, Germany, Netherlands, 8 other countries, Japan, China, Singapore. So pretty expansive. And then they talk about the book value and the asset revenue generation based on the locations they just discussed. Now here, this is one of the most interesting pages to me, because it breaks down the customers that they discussed before, not only in a longer list, but it breaks down how much of their effective rent that they're responsible for. So you can see that their top 10 customers only make up a little over 13% of their total net effective rent that they bring in, which is way lower than I expected, but not necessarily a bad thing, because the smaller these percentages get, the more diversified they are. So you can see among their top 25 customers, they make up only about 20% of the effective rent, which means they have a lot of customers. And obviously, as you get smaller in the amount of square feet leased here, you'll start getting more random little micro-cap companies. But this is a very solid list of their 25 biggest companies. Most of these are household names. Some of them you may not recognize off the bat, but they go into a lot of household names. So, aside from the 10 we discussed earlier, Siva Logistics, BMW is a huge one. The US government even rents from them. Panasonic, Ryder Systems, Pepsi, Staples. Pretty recognizable names, all pretty solid companies, and although they're probably not having the best of time now, most of them are going to come out of this situation. And they did release a press release not that long ago, talking about the rent collection rates, and they were in the high 90s. They did say some tenants asked for rent relief, but it was only they asked for rent relief for coming months. Only 25% even asked, and of those 25%, most of them just asked to see if they would get it, and they won't actually be given the rent relief, nor do they need it. So I think they have a pretty durable business model in terms of keeping clients around in this time. Sorry, there's a bug flying around in my room. And if we continue here, not too much else that I wanted to look at. It is interesting to look at the breakdown of the percentage of their leases and the percentage of their revenues that comes from different areas, but that's more for fun. Not really going to change how I invest in them. For the most part, we know they're US and Europe heavy, and they have a presence in Asia. Can't really change that, and that's honestly probably where I would want them. Discussing their debt and assets under management. This is their consolidated debt listed by maturity. They don't have any near-term debt for the most part. But looks like starting in 2022, they will have some senior debt that they will have to fork over money for. Obviously, these are all in thousands, so that's like $931 million. Not exactly light. But yeah, just a disclosure, I do own a small amount of this stock. Remember, I'm not a financial advisor. I'm not telling you to buy it. Do your own research. But just thought I'd talk about what I find interesting. Again, PE is not a good measure of REITs because that uses EPS, which here is also not correct. You can see it has a dividend yield of 2.54% currently, which is lower than most REITs. It's a $66 billion company by market cap. It has a pretty normal beta, and overall it's been on a really solid uptrend since about the 2008 crash. But yeah, hope you guys enjoyed